Now, when it comes to artificial intelligence stocks, most people tend to talk about the big dogs like Microsoft or Google or Meta, those types of companies. But in today's video, I actually want to switch things up a little bit and talk about three stocks that are a little more under the radar when it comes to AI. And for sure, these stocks are going to be much higher risk. They're not safe options like Microsoft or Google. In fact, all three stocks in today's video have been crashing by huge amounts. They're all down well over half their entire values. But sometimes where there is higher risk and a crashing stock price can come opportunity for the investor that is willing to buy into that fear. And in my personal opinion, all three stocks here fit that bill of high risk, but also high reward potential for the long term. As always though, just please do your own research and make your own decisions. Don't just copy someone on YouTube. Like I said, these are higher risk stocks, but I'm just sharing my opinion on them and I happen to like them and I think that they have a lot of potential for the long term. But if you appreciate these type of videos, and my hard work that I do here on YouTube, please consider subscribing, hitting the like button. Those two things help keep this channel alive and it means the world to me. So thank you for all that support. But let's not waste any more time, guys. Let's jump straight into these three under the radar artificial intelligence stocks that I happen to like for the long term. All right, guys. So in no particular order here, let's actually do an order. Let's go from highest risk to lowest risk. So starting with the highest risk, let's go with stock number one. I'm going to go with the fintech Upstart Holdings, ticker symbol UPST, who is using artificial intelligence to disrupt the traditional credit ratings and money borrowing markets, which are estimated to be worth trillions of dollars. And for context, Upstart only does less than $1 billion in sales per year, so there's giant room for growth there. But by using artificial intelligence, they're able to analyze more than 1,500 variables for grading a potential buyer versus legacy systems that only use around 30 by comparison. What this results in is that Upstart is able to predict things like fraud, defaulting, and other risk factors at 4 times greater precision than traditional FICO scores, while also providing cheaper rates for borrowers too, at usually more than 40% lower rates by comparison. And the great thing about their platform is that it gets even smarter over time as more and more lenders and borrowers use it, making their services highly attractive to customers, which is why you've seen their bank and credit union partners grow every single quarter, along with their newer auto lending platform that has partnered already with close to 800 different dealers while saving borrowers an average of almost $6,000 on their auto loans. And because of this, Upstart's financials have seen periods of huge explosion, especially in 2021 where revenue skyrocketed by over 250%. The problem, however, is that the macro economy is in a bit of a disaster right now, causing their revenue growth to be almost flat last year, while profits actually turned negative. And if you think that's bad, well, sales are even expected to actually decline this year by a whopping 35% before seeing a recovery of about 40% growth the year after. Again, though, in my opinion, this isn't so much a company-specific issue with Upstart as much as it is just a general macroeconomic issue due to inflation and interest rates that are making it riskier for lenders to give out loans and harder for borrowers to pay back their loans. In fact, Upstart's loan delinquency rates have literally more than doubled since 2020, and their current macroeconomic index that measures the damage being done by the macroeconomy is also around twice as bad right now as it was in 2021. The good news, however, is that the stock has been completely destroyed as a result of all this, with the stock price falling from a height of over $400 a share all the way down to less than $15 today. That's going from triple digits to now approaching the single digits for a mind-blowing crash of over 95%. And right along with it, the valuation has also fallen from a price-to-sales ratio of above 40 all the way down to just about 1.2 today. Assuming that the macroeconomy does eventually recover and Upstart is able to convince lenders once again to take a chance on their newer AI technology, then this could be one heck of a buying opportunity here for a disruptive fintech that I think has a lot of long-term potential. Until then, though, it will probably continue to be super volatile and high risk. So I don't blame you at all for staying away from a stock like this, but I'm personally buying a small amount myself the more that it falls. All right, now moving on to stock number 2. For this one, I'm actually going to go with a company that uses AI for cybersecurity. And you might recall that in my best AI stocks for 2023 video, I had chosen Palo Alto Networks to fit that role. But ever since that video, the stock proceeded to soar by over 33%. So instead, for this video, I'm going to go with a different stock here that is not only down a huge amount right now, but in my opinion has just as much future potential as Palo Alto, and that is CrowdStrike, ticker symbol CRWD, who has now crashed by over 60% from a high of almost $300 a share down to just around $100 today. But again, long term, this could be an absolute winner. First of all, the cybersecurity market itself is expected to almost double in size over the next few years, according to Statista, reaching almost $300 billion just by 2027 alone. For context, CrowdStrike only did around $2 billion last year, but there's good reason to think that they'll be able to steal more and more of that market over time, thanks in large part to their cloud-integrated cybersecurity platform called Falcon that uses artificial intelligence to detect, monitor, and protect users from all kinds of different cyber threats. In fact, thanks to its machine learning capabilities, it's able to process literally trillions of cybersecurity events every single week. And the cool thing is that every single one of those events gets added onto Falcon's database so that it can gradually learn from them and become even stronger and more efficient over time, which is pretty much the whole point of AI and machine learning, to get smarter over time. And you don't even have to take my word for how effective their platform is. You can literally see that for yourself in their retention rates and the customers they serve. Ever since their IPO, CrowdStrike has consistently carried a monster retention rate of above 120%, which means they're not only keeping their customers, but they're also upselling them on more products and services over time because of how satisfied they are with what they're already getting. And speaking of those customers, 70 of them are Fortune 100 companies, including telecommunications giant Verizon. 15 are of the top 20 largest banks, including Goldman Sachs. They serve 5 of the 10 largest healthcare providers and 7 of the 10 largest energy solutions companies as well. And yet they still grew their customer count by over 40% last year. And yet, despite that growth being so strong, it's actually the main reason why the stock has been crashing, believe it or not, as revenue growth is slowing down right now because of the horrible macro economy and having to compare to the giant growth that they saw during the stimulus-fueled pandemic with lockdowns and more internet use, therefore needing more cybersecurity. But that caused their sales growth to drop from over 80% back then down to around 30% right now. But to me, this is not really a giant concern because I still believe that this is due to outside factors that are not really company specific. And even regardless of that, 30% growth is still pretty damn impressive considering the previously high growth already. And if you look at their earnings per share, it's kind of the same story, dropping from almost 200% growth in the previous 5 years to now 56% expected over the next 5, which is also still really good growth, especially when you consider how much the stock crash has brought down their valuation from a PEG ratio of almost 5 down to just about 1.5 today, which is literally about the same PEG ratio as the sector. So they're basically valued almost the same as the sector, yet they're growing. The sector is like a 1.5 also. So they have the same value as the sector, yet they're growing much more and still have huge future potential. And that's why you even see the lowest analyst price targets on Yahoo Finance still higher than where the stock is currently trading today. So when I look out into the future of AI and especially within cybersecurity, I just think that those are markets that will only get larger and larger over time because technology is not going anywhere and the use of the internet and the cloud is only going to go up until I believe that almost the entire world is going to be run on it. And at that point in the future, I just think that in order to keep the world safe, you're going to need much more cybersecurity than you already have today. And so when I see a high growth major player in that market that is crashing like this down, over 60%, well, that could be a pretty good buying opportunity for the long term. I do not own the stock yet myself, but man, am I tempted to just kind of start opening up a very small position on it, see where it goes, maybe pick up some more shares if it falls, turn it into a very long-term position. Seems very appealing to me. Again, I don't own it yet, but I am highly, highly considering it, and you might see an update video from me soon saying that I actually ended up buying some of the stock. All right, guys, that's going to leave us now with the third and final AI stock of the list. And for this one, I actually kind of need to explain it a little bit because I'm going with Tesla. And I know what your initial reaction is to that. Everybody knows about Tesla. It's one of the most popular stocks in the market. How in the world can you consider this under the radar with AI? Well, the reason that I actually feel that it still qualifies for this list is because most people talk about them for their electric vehicles and the energy parts of their business. In fact, the famous investor Ron Barron thinks that they'll reach a $4.5 trillion market cap, which is insane to think about, but he thinks they'll reach that for just their car sales alone. He doesn't even factor in artificial intelligence into his whole equation. But I personally feel that Tesla is much more than just an EV company, and I think that they don't get nearly enough recognition for their work in AI, which I actually think has even more future potential, and it's what really sets them apart from the competition in a very crowded market. Because first of all, we all know that self-driving cars are the future because of how much more efficient and even safer they are. Not only would I trust computers to drive much safer than regular humans that are constantly being more and more distracted these days with cell phones, or even intoxicated with what they drink or smoke, or you think of how many people drive when they're really tired and they can literally fall asleep at the wheel sometimes, which are all things that AI doesn't really suffer from. But on top of that, autonomous driving also saves the passenger a lot of precious time that they can use for either resting or even being productive with things like their work or something else. In fact, it's estimated that the average human spends over 4 years of their life driving a car. And you know that there's people that drive way more than the average person too. So just imagine how much time and energy we would all save with an autonomous car driving us around. There's huge value in that. But on top of it, it's also way more profitable, and not just for logistics, which is hugely important to the entire world's infrastructure. So think about how much money and time it would save if trucks are driven autonomously 24/7 without needing rest breaks from drivers, but it's also really important for robo-taxis as well. In fact, why do you think that so many people continue to invest in stocks like Uber and Lyft when they literally lose billions of dollars every year? It's because their primary costs are having to pay drivers, but investors know that in the future, these cars will eventually be self-driving, which means humans won't be needed, and thus these companies should be profitable if they're still around. And personally, on an ethical level, I'll be honest, I hate the idea of so many people losing their jobs, but I'm just being realistic here. I think we all know that this is the future that we're heading towards. And so when you look at these markets, logistics is already worth trillions of dollars, and robotaxis are growing by over 80% per year, not to mention robotics, which is growing at over 20% per year just in service robots alone. And we all know how useful and efficient robots can be, since they don't need any breaks and they can literally work for you 24/7 without even having to pay them. Well, these are giant markets that Tesla is trying to break into with things like their self-driving semi for logistics, a robo-taxi service that they aim to launch next year, and even a Tesla bot that they plan to deploy literally thousands of into their own factories, not to mention sell to other companies. And they've even showed them off building more robots of themselves too, which is kind of crazy. But on top of that, Tesla is consistently trying to hire the best AI engineers in the world to work on their various projects that involve deep learning, computer vision, motion planning, and other mechanical and software specialties. This right here that I'm showing you, this is from their robots careers list page. But when you look at other areas too, like self-driving, for example, it's true that Tesla vehicles are not fully autonomous yet, but they do already use many sensors and machine vision cameras to provide level 2 full self-driving, which are also being powered by their own in-house computer chips that are used to process all of that data and information that is being collected, which at the time of first being announced a couple years ago, it was already 21 times more powerful than the previous chips developed by NVIDIA. And these chips are also being used by their Dojo AI supercomputer that is apparently so powerful, it's so powerful that it even tripped the power grid in the city of Palo Alto where it was used. This computer, by the way, is used for machine learning and video training for autonomous driving that continuously collects data from its huge fleet of over 3.5 million vehicles that are already out on the road, continuously collecting data. And all of these vehicles have at least the basic level of autopilot. It comes standard with every single Tesla vehicle. So this fleet is just continuously collecting data, and it's feeding that data back to the Tesla mothership back at home, and it continues to develop its neural network, and it gets even smarter and stronger over time. And yet, despite all of these pros and all the work that they're doing with AI, Tesla's stock has actually gone through a giant crash recently, down around 60% from the top, which when you couple that with the industry-leading margins and profitability that they have, you actually get a forward PEG ratio of only about 1.6, which is just about 18% more expensive than the sector. And I think that's pretty reasonable when you consider how their profitability is actually expected to get even better from here, thanks to new innovations that they're implementing into their new Mexico Gigafactory for their next generation models that include a 40% reduction in factory footprint and a whopping 50% reduction in overall costs. By the way, they're already reducing the cost to build their Model 3 by 30%, but the next generation will be a 50% reduction. That's huge. And again, they're also going to put their Tesla bots to work on them too, so that's another margin advantage that they have over all the competition. Meanwhile, their financials continue to impress year after year, and I really think the sky's the limit for them. The only question is really if Elon Musk is overpromising here, which he does tend to do at times, and also if they're able to execute, because Tesla's stock is still pretty expensive. It's always been highly valued. It probably will always be highly valued. And so if you don't execute and you start making a lot of mistakes that allows the competition to start catching up to you, then the stock is going to crash even more and investors will be in trouble. So even though I still believe in Tesla's vision and I'm heavily invested in Tesla stock myself, I do think that exercising some healthy caution here is justified as well. And that goes obviously without saying for all the stocks on today's list. All three of them are very high risk, but again, in my opinion, they all have a lot of future potential. So I still really like all of them. But let me know what you guys think. Do you agree with any of my thoughts here? Are there any other stocks that you think should have made this list? Let me know, because I might actually make a follow-up video and include some more under the radar AI stocks. So I'd love to hear about what you guys like out there. But thanks again for stopping by. Thank you for all the support, everyone. I hope that you enjoyed the video. Now we'll catch you in the next one, my friends. Take care, everybody. Bye-bye.